Guys, these are 5 stocks that have potential great returns, one of which has a 772% potential return over the next 10 years. And that stock is our first one to look at, Southwest Airlines. Ticker symbol is LUV. Now, Southwest has been hit hard with the pandemic. And then since then, with the whole Boeing issues, the 737 issues, it has been a company that I've been following for a while. If you look right here, in the last 5 years, the stock is down 41.5%. In the last 10 years, it's only up 33.9%. And year to date, it's basically even. So guys, I personally believe that this is the best airline operator in the country. Leading into the pandemic, they had something like 48 years in a row of profit. They do a great job of hedging their fuel costs, as well as they stick with the exact same plane and more economical routes. They're not trying to be the company that gives everything to everybody. They're very specific. We want to know our planes, so we're going to buy the exact same planes. Now, as of late, they've had issues with that because they're all Boeing 737s. But here is my thesis. If you look at Southwest Airlines, here is their income statement going back. They have record revenue, 26.09, which is higher than the year before the pandemic of 22.43. So big time revenue, right? But look at their profit, $465 million versus $2.3 billion right before the pandemic. So a huge drop in profit margin. Going back further, here are their profit margins by year. 10.3%, 11.2%, 15.8%, 10.7%, and 10.9%. See a pattern here, guys? It's all essentially double-digit profit margin. And currently, they're at not even 2% profit margin. So the question is 2% their new normal? Or once they get back to stability and back to their regular levels, are they going to revert back to 10% to 12%? Now, keep in mind, in this year before the pandemic, they had lost $870 million because of the 737 MAX issues. So this profit level was still after losing $870 million, according to their 10K on the 737 MAX. So I think their profit potential is north of 10 to 11%. I think as they grow and grow and grow, they could actually get 15 or 16% potential profit margin. And that's my thesis here. So how did I get to 772% return? Well, first off, before we get into that, let's just look at analysts and see what they're saying. Guys, analysts are expecting $1.47 in profit here in 2024, going to $3 in 2027. Still not out of the woodwork here yet. I don't think that's really even them getting back to normal. And let's look at their revenue growth. Still some very consistent revenue growth. 4, 5, 6, 7, 8% revenue growth. So this is where my theory goes. Let's pull up our stock analyzer tool and pull up the last time I did Southwest Airlines. Now, my 772% return is based on my highest assumptions, but that's what makes it so great. If we can always find these with 772% return, I don't think my assumptions were ridiculous, not like the NVIDIA assumptions or the Tesla assumptions that existed 3 years ago. I'm assuming 6% revenue growth for the next 10 years. That's not absurd. If they are able to increase the price of their tickets with inflation and nominal GDP growth, as well as add some routes, that's very reasonable. Next, 16% profit margin and free cash flow margin. Yes, that will be harder. But again, going back, the 737 MAX, they're working through a lot of issues, upgrading their computers. This isn't some absurd number. Is it going to be hard? Absolutely. But that's what I want in my high assumptions. I want to put hey, it's possible, but it's just going to take some effort. Now, my price to earnings ratio and my price to free cash flow. What should I be willing to pay for Southwest? Well, it's basically the only airline I'm willing to own. And I think they're the best operated airline. So I'm willing to pay a premium for that. I'm putting in a 22 multiple on earnings and free cash flow. And I'm sitting here, I do all the math, and this is what it leads to. The $26 billion they did in revenue last year times 1.06 to the power of 10. This is 6% a year growth for 10 years equals $46.5 billion in revenue in year 10. Now, I apply that 16% profit margin and free cash flow margin, and that gives me net income of $7.5 billion. Okay, significantly higher than it was pre-pandemic, but also a lot more revenue of 46.5 versus the 20-some billion, 22 billion they had before the pandemic. Now from here, what's my multiple? 22. So I'm taking my 7.5 billion, multiplying by 22. That's $165 billion market cap. What are they at today? Versus 18.8 billion. What is that growth? 772%. That's where I'm getting my total potential growth from the market cap of 18.8 billion to 165 billion. Again, that is my roses of assumptions, but I wish I could invest in 30 companies that had these kind of rosy assumptions, with my rosy assumptions not being absurd. It's not like I'm sitting there going, well, they're going to grow at 20% a year and have a multiple of 40 and all these. No, I'm sitting there saying, listen, it is a top quality airline. They could get 16% as they grow and grow and grow. They could get more efficient and lead themselves to a nice multiple. What's more likely? More likely that they're going to be around 12% or so on their profit margin. I'm okay with that. It's still going to lead me to great returns. Stock number 2, Alibaba. Guys, look at Alibaba. 72.57, all-time high of 319 back on October of 2020. So what's the deal with Alibaba? Guys, this is what I talk about when I talk about emotion. Look at this, just steady decline from Alibaba. Steady decline. Baba could do no wrong. Baba is the best. 2, China's invading Taiwan. China sucks. People are leaving China. People are leaving. Do you see what I mean here? News follows the stock price. Guys, is China going away? No. That's a fact. 2, more importantly than that, that's a ridiculous statement. 2, what's more important is, are they still a fast-growing economy? Absolutely. Are they losing people? For sure. But they actually have more billionaires in the US now. Yes, there's 1.6 billion people or 1.5 billion people there, so it's more likely, but they're a lot poorer than us. China will grow faster than us. Why? Because, and I'm not trying to get too much into the economics of it, the more and more wealthy a country is, the harder it is to grow. Just like it's harder for Apple to double, Apple and Microsoft's gonna be harder for them to double their revenue than a company like Palantir, a younger company with a lot less revenue. It's harder to grow the bigger you are. But I think the sentiment is what's driving this price so much. Right around here, it was all about ADRs. You don't own the stock. You just, well, guess what? You didn't own the stock here either. You don't own the company. Yeah, you didn't here either. But that didn't matter on the way up. That just mattered on the way down. Here's the interesting part, guys. The last 10 years, they're down 22.7%. Last 5 years, down 61%. Let's look at the numbers here. Down 61% in the last 5 years. But here's the interesting part. 5 years ago, 52 billion in revenue. Now, 120 billion in revenue. What? Let's go to the cash flow, because the cash flow is what really I'm gonna show you guys as something amazing. Last year, 22.8. 5 years ago, 14 billion. So 50% more cash flow, over double the revenue, and the stock is down significantly over the last 5 years. That doesn't mean the stock's a good price, but it's all about understanding the emotion of what's going on here. This is what I talk about time and time again. All the best investors will sit there and say, it takes a lot of emotional fortitude to be able to watch your stock decline, but look at the fundamentals and say, what's really going on here? And guess what, guys? When a stock declines, you better believe there's gonna be a negative story. Look at Tesla and Google. Google, they were literally calling for the CEO to be fired when the stock was at $85 a share. That was a mere year and a half ago, whenever it was. And now the guy's a genius again. Look at Tesla. Tesla's down 70% from its all-time high, with revenue up over 80%, profits up. And now people are saying, well, Elon is crazy. He's distracted. Guys, he's been distracted since day one. That's the reason he's been able to build Tesla. He's obsessed, but he's distracted. He has so many ventures going that have been going for a long time. News follows the stock price. And I have learned more and more as time goes on that it's all about the emotion of things. It's all about understanding those emotions and being able to sit there and make a decision based on fundamentals, but you're going to compound and make a ton of money by keeping your emotions in check. So my thesis on Baba, I'm looking at this saying, okay, Baba's currently selling $183 billion market cap with $26 billion in free cash flow over the last year. What is that? That is 7 times free cash flow. Seven times free cash flow when the historical average is 15 or 16. So right there, you're doubling up on BABA. Once the news shifts, because remember, you might tell me the news isn't going to shift on BABA. Sure it will. Remember, over here, the news was ADRs. The news was you don't actually own BABA the company. Now I don't hear about that at all anymore. Now it's all about China invading Taiwan. Is China invading Taiwan a potential risk? Sure. But what happens to BABA? Do people just stop buying things? It could be a temporary problem that causes a drop in revenue and profit. Okay. I just sit there and say, if there were 30 situations in which I could buy with BABA, I would absolutely do it with these numbers. And I'll show you right here based on our stock analyzer tool. Let's pull this up the last time I did BABA. Guys, let's look at analyst estimates actually. Earnings per share, not a lot of growth, $9 to $10. Of course, my question is, where's the bias here? Because it's been such a loser for so long. Is that bias from analysts showing up? Maybe, because it's interesting to me that I look at the revenue growth and I'm like, wait, how is the revenue growth 7, 8, 6, 5%, and yet the profit growth is 0? And they're buying back a ton of shares, which I absolutely love. Jack Ma, their chairman, they've both bought $300 million worth of shares total. The company's buying back $25 billion of shares. They're buying back 1/7 of the company. So what that means is if you own the business, you're now being rewarded by getting a 15% ownership bump as a percentage of the revenue. That's incredible. And I look at this thing, okay, so maybe there is this perception issue. So I sat there and said, let me look at the numbers myself. I'm putting 3, 6, and 9% revenue growth for the next 10 years, okay? Profit margin. I did 15, 19, and 23. And if you look right here, free cash flow is always above their profit margin. So I put a higher free cash flow number in. 17, 22, and 27. Now for the multiple. Guys, these three areas right here, the PE and the price to free cash flow and your desired return, this is essentially where you sit there and evaluate the company and say, what do I feel about this company? Do I want more margin of safety? What's the multiple? Me personally, I sit there and put, okay, what do I think the market's going to, in the long run, assign to BABA? I put 16, 18, and 20 for both these multiples. And for my desired return, just for the video, I put in 9%. This is what I consider to be intrinsic value. What would I pay for the company to sit there and say, let me match the market? What's it worth on the market? 9% return? Okay. I hit the analyze button. Now remember, these prices don't include any margin of safety. But look at this. I have a low price of 120 to 130, a high price of 336 to 395, middle price of 200 to 250. So our good friend Guy Spear bought it for what I think is about the right price. Now, it's taken a tank on him, but he's still holding it. A lot of other value investors, great value investors like Michael Burry, have bought this. So I look at this saying, is the juice worth the squeeze? Guys, I would love to buy 20 companies, 30 companies with Alibaba's size with this kind of potential. I'm not going to be right on all of them, but even if I'm a little right on them, I'm going to do very, very well. And that's my thesis with BABA. But again, what's the hard part? It's about looking wrong for a long period of time. Guys, I told a story yesterday in a video. I bought Carnival Cruise Line. I made money on Carnival Cruise Line. Guess what? I was 100% wrong on Carnival Cruise Line. And I want to repeat that over and over because everybody tends to think in the short run that where the stock price goes, that determines they're right or wrong. That is not true. In the short run, I made money on Carnival Cruise Line, but I was wrong on Carnival Cruise Line. They issued more debt than I thought they would, and they diluted the heck out of investors like I did not think they would. So I look at that going, so I just got lucky that the market price skyrocketed on me and I sold at 28. Okay, great. So I made money on Carnival Cruise Line overall, but I was wrong on that one. I'm down on my Alibaba investment. I don't think I'm wrong on this one. I'll know in 5, 7, 10 years. You might sit there and say, oh my God, that's so long. Yeah, that's the way it works. That's the hard part about investing because you have to be okay sitting in your room, sitting in your house all alone, watching your stock go down. That's the hard part. Sitting there wondering, am I wrong? This is what makes investing tough. And it's exactly why I created our software in the community. I wanted people to be able to understand. I wanted to be able to fundamentally understand a company, evaluate it. But after that, the hard part starts. The hard part is, how do I stick with a company when the stock is going against me, but the fundamentals are getting better? That's the truly hard part. And in our community of thousands of like-minded investors, that's what they're there to do. They're there to sit there and support each other and talk about our investments. People don't agree with me on BABA. Some people think I'm absolutely wrong in our community. I'm fine with that. We don't all agree. That's what makes it a great community. So if you want to be able to sleep better at night and understand your investments better in order to make more money, very simple, guys. Click the link below. Join the community. It's only $7 for 7 days. And I encourage you to sign up soon because a wait list is starting very soon because we want to limit the number of people joining the program. So go sign up now before the wait list starts. Stock number 3, Disney Corporation. Guys, a very similar thesis I have for Disney that I have for Southwest Airlines. And let me explain why. You look at Disney right here and look at its profit margin over the last 5 years, 3.87%, 3.36%. Okay, how do you know if that's good or bad? Well, I look at the income statement. First off, pre-pandemic, record revenue, basically $70 billion. We're at $89 billion today. $89 billion. But let's go look at the profit. $11 billion back then, 2.3 today. Now, what were the profit margins in the 5 previous years? Well, 15.8%, 21%, 16.7, 16.8, and 15.9. How does this look compared to 3.6? So just like Southwest, I'm sitting there going, Disney spent a lot of time growing this Disney Plus, growing a lot of things. They've been having these battles. They haven't been focused. That is not good. But I look at this saying, how is their profit down 80% as a profit margin? Is this a new normal for Disney? Are they just going to make 3 or 4% for the rest of the time? If that's the case, it could still be okay because look at the chart right here. Again, I'm not saying the chart determines if a stock is good or bad, but we had an all-time high of $202 back on March 8th of 2021. 3 years ago now, it is down well over 50%. Because it's, oh no, less than 50%, 113. I got fortunate and bought some at 85. And again, I'm not saying that to say, look, I was right. I'm upset about that. I want it to go down further. That's the mentality I want you to have. I want you to feel like, oh my gosh, I really want the stock to fall even further so I can buy a great company at a great price. If that makes sense, but it's hard to get your head around, that's okay. It does take a little bit of time. And that's what I did and finally got around to it. I look at this saying, okay, I was fortunate to buy, not at the 52-week low, but pretty close to it as it went further, and was hoping it was the start of something big, a big drop in the company. So let's look at Disney stock and the stock analyzer tool. I just did it a few weeks ago. My revenue growth assumptions, 3, 5, and 7. Profit margin, 6, 12, 18, 6, 12, and 18. So you might be like, well, Paul, you said it was 15% plus. You're right. That's why I'm going to change this. But I was being conservative in that last video. Let's go with 9, 14, and 19. 9, 14, and 19. Now, what PE and what price to free cash flow would you assign for Disney? Guys, I put 18, 21, and 24. If somebody said to me 20, 25, and 30, I don't know if I'd necessarily disagree with them. This is Disney. They have an incredible product of movies, all these things they have in their portfolio. They have these amusement parks. Like, how do you recreate Disney? It's going to be very, very, if I gave you $200 billion today and said, go compete with Disney, $200 billion, you'd probably have a hard time. People who love Disney, they keep doing it. This is the big thing with Disney. All right. Now, again, 9% dollar return. I hit the analyze button. Again, guys, no margin of safety in here. I have a low price of 75, high price of 260, a middle price of 150. And for a company as big and well known as Disney, that seems pretty attractive to me. And that's why I own the company. But again, don't buy it just because anybody on the internet owns it. Do your own research, join the community in order to do the research with the community, as well as use our tools to be able to determine the right price. Now, these are annualized returns. I want to show you that potential that Disney has, the same as Southwest. So a couple metrics we need to know. First off, Disney's market cap is $207 billion. To make it easy to remember, let's call it $200 billion. And last year's revenue was $89 billion. To make it easy, let's just call it $90 billion. That way just makes it nice and simple. And as you remember, in our stock analyzer tool, we had a high growth rate of 7%. That means in 10 years, it's pretty much going to double. So we're going to take our revenue of $90 billion and double it. So we're going from $90 billion times 1.07 to the 10th power equals $180 billion. Okay, now, what was the profit margin I put in on the high side? Well, I put in 19%. So times 19%, That equals, so 20% would be 36 billion minus 1% of that. So let's call it $34 billion in profit. Okay, 34 billion in profit. Now, what's that PE? Well, if you remember, the PE we did was about 24. So times 24, let's do some math here. 680 billion plus 24, 96 equals $776 billion market cap. Okay, $776 billion market cap, and it's currently 200. We have a 3.35x, which is 235% potential return. That shows you how incredible Southwest could be. But even owning a great company like Disney, you could get 235% just on the growth of the stock, not including if they do any buybacks or anything like that. That is what's incredible about the company. You sit there and go, as they buy more shares, if they start to buy shares back, they're going to split that market cap amongst less shares and drive that stock value up. Stock number 4, PayPal. Another one that has been just obliterated. 5-year return minus 40%. Guys, we have videos. We're talking about PayPal when it was above 300 going, we don't really like this. $310 back in July of 2021. It has fallen so hard. 52-week low back in October of $50. That's an 85% drop in stock price. Maybe higher than that. That's incredible. And in that time period, 2021, it did, in the previous 1 year, it did 21.5 billion. This last year, it did $30 billion in revenue. Okay, well, what about profit? About the same, actually. So I'm looking and going, okay, well, the revenue's up a lot, but the profit's the same. That kind of stinks. But now the price is down 85% and I can get the same profit for that. Doesn't that make you go, that's pretty interesting. The market cap is about $69 billion, so it's not selling super cheap at 16 times earnings. And they do have other issues. The number of users has declined for the first time, but the total transactions per user are up. That's what I love seeing. And the amount of money spent on each transaction is up. That's a very positive sign for PayPal. So let's look what analysts are saying about PayPal. Much better growth assumptions on the earnings per share. 560 this year to 1068, almost 2x. Now, the only thing I'm a little apprehensive with on PayPal is some people I'm not really a huge fan of kind of like PayPal. So it kind of makes me go, okay, what am I missing here? Maybe I'm not. Maybe, just the sun shines on dog shit sometimes, I guess, right? But I look at this going, okay, when it comes to trust in online transactions, PayPal is the way. They own Venmo. Venmo is incredible. Now, I had a recent problem with Venmo, but it's so weird. I don't know what the reason was, but I just started a new account, very easily hooked up my account, done. Now I'm paying people again. Now, what's their revenue growth? Yes, this market is very saturated and growing. 32 billion to 51 billion though. Double-digit revenue growth. Not bad. So let's go look at our stock analyzer tool and see what the potential for PayPal is. Pull it up in our history. I did 4, 7, and 10% revenue growth. I did 12.5, 15.5, and 18.5 profit margin. Free cash flow, I did 16, 20, and 24. Now, for PE and price of free cash flow, I did 13 and 19. Because of the competition in the finance, I do think internationally, though, whenever I buy something internationally, I always use PayPal, 100% of the time. Because I'm like, listen, I know PayPal is going to have my back if there's an issue. And that's really important when it comes to money. And again, my 9% return, not including any margin of safety. So guys, I look at this going, even if you just want to base it on earnings, 52 on the low, 153 on the high, 92 in the middle. I look at this going, a lot of potential return here. If I paid today's price and my middle assumptions occur, there's a lot of potential there. 18% returns over the next 10 years. Again, I look at this investment going, if I could have 30 companies that fit this criteria, would I be excited? The answer is yes. Final stock, Nike. Let's pull it up here, baby. Look at this fall from grace on Nike. All-time high, 179.10 back in November of 2021. 2.5 years ago, it hit a 52-week low last year of 88.66. Got pretty close to that recently, but now it's at $95 a share. Guys, what would the world look like without Nike? Literally, they just signed Caitlin Clark, which I think was a great signing, and they're paying her I think it's something like she's going to make $74,000 playing basketball, and she signed an 8-figure Nike deal. Now, I don't know if it was over X number of years, whatever the thing is, but the bottom line is I'm sure she's going to be making multiple 7 figures a year just with Nike. And I look at that saying, Nike's got Jordan Brand, Nike's got LeBron, Nike's got Caitlin Clark now. But this is another company where people were criticizing us, Nike's not going to fall. Okay, well, maybe it won't. Guys, don't ever believe that. As Dalton put on Twitter the other day, at some point, the stocks that you love and own will not be favored by the market, and there will be a decline. That's where the emotion comes in. Are you okay with people looking at you saying, you idiot, how do you own that company? It's terrible. And then you have to sit there and say to yourself, I own Nike because of this. Look at this consistent revenue growth, 30 billion, 32.8, 34, 36, 39, 37, COVID, 45, 46, 51. That's why you own Nike. That's why you own the best apparel shoe company in the world. Now, are you going to make as much money as owning some other upstart? No, of course, probably not. But if you can sit there and look at the sentiment shift and still be okay owning this company, you could potentially do very, very well. So what are analysts saying? Well, 362 earnings per share to 633. Some big growth right there. Well into double digits earnings per share every year. Revenue growth? Not a ton. 1%, 6%, 8, 10, 7. Okay, not bad. So, stock analyzer tool. Let's pull it up right here into Nike. So guys, I did 3, 5, and 7% revenue growth. For both profit margin and free cash flow, I did 10, 11, and 12. Now, for my multiples of PE and free cash flow, earnings and free cash flow, I did 20 on the low side, 26 on the high side, 23 in the middle. Again, if somebody said 20, 25, 30, sure, it's all about where you, if somebody said to me 15, I'd say you're nuts. Like you can't assign 15 multiple to Nike. That's the historical average for all companies. Nike is a premium company. And again, the 9% desired return. Now guys, before I do this Nike analysis, 2 things. 1, don't forget to sign up for the community, $7 for 7 days. Click the link below, get in before the wait list. And 2, if you want to see the 13 companies I currently own in my portfolio, make sure you watch this next video. It'll load right up. But here's where Nike stands today. Stock analyzer. Okay. Low price of 61, high price of 120, middle price of 86. I have on my watch list at $85 a share. Thank you very much for your time.